Hey everyone, Chad here. In this video, we're going to take a look at Wealthfront and Betterment, two robo-advisors that have amassed more than $10 billion of assets under management. In a field of a few robo-advisors, these are the two that stand out. If you're wondering why robo-advisors came about, it's because the founders of these companies said, wait a second, you have human advisors, whether they be mutual fund salespeople or investment advisors, charging their clients 1.5%, 2% in fees, maybe more. And also a lot of these advisors are putting their clients in actively managed portfolios, which have shown to consistently underperform the market. So these robo-advisors embrace a different investment strategy, typically charge lower fees, which we're going to take a look at. Wealthfront, Betterment, and other robo-advisors will get to know you through a series of questions, typically in the format of an investor profile questionnaire. Your investor profile speaks to who you are as an investor, your objectives, risk tolerances, time horizons, and some other pertinent information. Once they figure out and get a sense of what you should be investing in, they'll choose from a batch of ETFs. So with Wealthfront, they have a primary list of ETFs, which consists of 9 ETFs. A lot of these are from Vanguard, as you can see here, State Street. Then they have a secondary batch, which includes ETFs from Schwab and iShares, and then we see some more Vanguard funds here. Wealthfront's investment strategy boils down to passive investing through low-cost index funds that will help to manage your risk, lower your taxes, and minimize your fees. But they don't stop there. They offer something called Passive Plus, which kicks in accounts that have $500,000 more in investable assets. Then it will focus on advanced indexing, which commonly called smart beta. So their strategy is designed to increase your returns by weighing securities in your portfolio more intelligently. Betterment uses low-cost ETFs as well. For stocks, they've chosen funds from Vanguard, and for bonds, they've chosen funds from iShares and Vanguard. Betterment embraces passive investing as well, and they talk here about low cost, low taxes, optimal risk. However, they too offer smart beta portfolios in partnership with Goldman Sachs. They also have partnered with BlackRock to offer income-focused or income-targeted portfolios. And it's worth noting that both Wealthfront and Betterment offer socially responsible investing portfolios. Wealthfront charges 25 basis points or 0.25%. That's their annual advisory fee. No trading commissions, no financial advisor salaries, as they say here. One thing to keep in mind though with these robo-advisor account fees is this is on top of the fees or costs associated with ETFs. So with the ETFs that Betterment and Wealthfront use, those ETFs cost anywhere from, you could say, 10 basis points to 20 basis points. So this fee will be on top of those fees. So you're probably looking at paying somewhere between 35 basis points to 50 basis points or so. Wealthfront does offer financial planning without human advisors through a solution they've created called Path. And the way Path works is it's basically financial planning software that you're going to interact with, that you're going to connect your accounts to and input information into. And it's going to continually update to produce a real-time financial plan that you can access and gain insights from. A major difference between Wealthfront and Betterment is that Betterment offers two investing routes. So this one here is where you would stay if you want to compare apples to apples. For 25 basis points, you're going to get personalized financial advice, low-cost portfolios, automatic rebalancing, and so on. I think Betterment does a better job of outlining what you're going to get, in my opinion. Over here, for 40 basis points, this kicks in at $100,000 minimum balance. You can access human advisors, so you can get in-depth advice on investments outside of Betterment. You can access certified financial planners for comprehensive financial planning advice. So that's one thing to think about when you're comparing Betterment and Wealthfront. A couple of things stand out with Wealthfront that Betterment doesn't offer, starting with a 529 plan, which is an account specifically designed to save for college. So if you have children and you want to save for their college expenses for the future, which includes tuition, room and board and books and so on, then you would come here and you can open up an account with Wealthfront. As a Wealthfront client, you might be able to access a portfolio line of credit, but you do want to read the fine print, so you have to have $100,000 or more. The current rates are 3.75 to 5%. You can borrow up to 25% of your account whenever you need it. What stands out with Betterment is what we've already talked about, in that you can access human advisors. So I have a great deal of respect for certified financial planners. I think comprehensive financial planning advice is very important. So this is something you want to take a look at. Secondly, if you want to open up a trust for a beneficiary, you can do that through Betterment, whereas you can't do that with Wealthfront. So this is another item here that is a differentiator. Wealthfront and Betterment are both excellent platforms, fantastic robo-advisors. They're leading the playing field with technology and innovation. Both make great cases for their tax-efficient investing strategies. So you can go over them, and if you do have a tax advisor on board, consult your tax advisor, see what he or she thinks. Both these platforms will build you low-cost portfolios consisting of ETFs for a low annual fee of 25 basis points. So have a look at these platforms. Best of luck with your investing, and I'll see you in my other videos. Bye for now.